Welcome back, friends. A soft landing and, in fact, above trend growth has already priced in US equities. Valuations are quite elevated as compared to history, and they will be constrained further by an eventual rise in interest rates. Whereas the inflation seems to be coming under control, the wage growth, the labor market continues to be quite hot, and Federal Reserve will be constrained to keep raising interest rates even if it is just a nominal rise. It always will be looking at this figure, and this will continue for some time. Not only the rise in the interest rates, but they will even be maintaining it at this high elevated level for many months down the road. So we are looking at a scenario where we have inflation coming down. That's good, but we have the earnings coming down and the interest rates going up. So that does not make for a good Goldilocks scenario, as many analysts are talking about. The alternatives that the Federal Reserve have are manifold. If they just see at inflation figures and forget about the labor market, then they can go ahead and even pause. But I don't think that's likely going to happen. The additions to payrolls are quite substantial, and the Federal Reserve is going to take note of this definitely, even in its next FOMC meeting. The rally across the major indices, that is the Dow Jones, Nasdaq, are up 14 and 3% respectively this year, has taken many by surprise, but they don't seem to be quite justified. This is something which was anticipated, as far as I'm concerned, in the wake of falling inflation. This had led to hope that sooner or later the Federal Reserve will come about and even start reducing the interest rates, probably in the second half of 2023. So since the markets look much in advance, they're trying to factor in the reduction in interest rates right now itself. The timing, however, if you look at from many perspectives of the reduction in interest rates, is fairly uncertain. This leaves investors staring down the barrel of potentially multiple more rate increases, which I believe is going to happen. And that could have the effect of further slowing down the economy and compressing the stock market multiples. Meanwhile, corporate America is slogging through a disappointing earnings season that arguably doesn't justify the market's advance in the month of January so far. The big household names such as Apple, Meta, and Starbucks have not only whiffed on fourth quarter earnings estimates, but have also offered cautious forward-looking commentary. The earnings growth hasn't been there either. The blended earnings decline for the S&P 500 for the fourth quarter is tracking at 5.3%. If that holds as the actual decline, then it will mark the first year-on-year earnings decline reported by the index since the third quarter of 2020. The combination of further rate increases and pressured corporate profit margins can lead to a deadly cocktail of a severe decline in stock valuations as we go forward and enter the summer. If we look at the market pricing so far this year, it's not even pricing in a soft landing, it's pricing in a takeoff. So it's pricing inflation to come down, it's pricing growth to avoid a recession altogether. It's pricing in central banks cutting rates starting mid this year. So the market in short is what I would say is priced for perfection at this point of time. And whenever that happens and the reverse happens, definitely you will get a big hit. And to get to know more exact, we have our detailed analysis ready as to what point of time the market will get hit the worst. When will this entire combination of falling earnings and rising interest rates begin to hurt, begin to hurt valuations the most, that will be the point of time when the stock market indices, the Dow, S&P, Nasdaq will get hit the most. And we have our analysis ready at what point of time this can hit you the most. Please do be a part of our Telegram channels, Prime Plus or Prime, and you can do that by WhatsApping us on 98208610044. Alternatively, you can also email us at globalmoneyinvestor@gmail.com. globalmoneyinvestor@gmail.com. Happy investing and have a real nice investing day ahead. Take care. Bye-bye.